Welcome to Ty's Daily Market Update. I'm Ty Wong reporting from New York, and it is Tuesday, August 25th. I'm going to spend like 3 slides on this, and that's a lot, and because it's actually, I think, written by somebody very important, and it makes some very, very good points. So it's written by an opinion piece written by Stanley Druckenmiller. He was Soros's top trader. Scott Besson at the time was worked under Druckenmiller. Druckenmiller has since semi-retired. He only runs his family office out of Pittsburgh now. Used to run a lot of money, but he's, I think, happy to to do what he's doing right now. And he says, and it's important because he is he is like a mentor to Besant. Besant will listen to him. Whether Besant will do what he's asking is a different story because there are different pressures. So he says, let the bond market speak. The Treasury Department announced on August 19th it would double the size of its long-dated buybacks. Yields fell within minutes, but by the next afternoon, they had round-tripped to levels above where they started. And he goes, the market's verdict was swift and correct. This wasn't liquidity management, which was the original intention of the buybacks when it started, but it was price management. And he says, this is a big mistake. Now, he says the bond market wasn't being particularly angry, being a vigilante. It was being a pushover that it finally started to clear its throat, and Treasury moved to quiet even that. Basically, what he's saying is politically, the 30-year yields had gotten high enough to attract attention and cause problems for the administration. He wrote, I spent 5 decades trading on a simple premise. Markets aggregate, put together information no committee possesses, and prices are how that information reaches decision makers. By the way, that's what Fed Chair Warsh always says. And it basically says if you mess around with markets, then one of the biggest problems is you don't know what the right price is. So, for example, when China controls and picks favorites and does different things to control markets called financial repression, the pricing is wrong. When the pricing is wrong, you don't know what's the right price. And that's very, very important. So he said, the long-term Treasury yield is the most important price in the world. It's the only fiscal disciplinarian the U.S. has left. He's absolutely right. He's talked about this before. Neither party, Republicans or Democrats, will run on entitlement reform. That means saying, you know what, we've got to pay out less in Medicare and Medicaid and Social Security because democracies don't repair their finances. They repair them only when a cost of inaction becomes visible and immediate, when mortgage rates bite, when auctions tail, when political price of a rising long bond finally exceeds the political price of touching spending. So what he's saying is every basis point of artificial yield suppression, which is what's happening when we buy long bonds, leads to is a subsidy to procrastination. It basically buys the government more time to be irresponsible. So, Druckenmiller was Besson's mentor, and I think in truth, he's a better market sage than Buffett. Buffett sounds very homespun from Nebraska, but if you want to talk a really smart guy who understands markets, maybe less so companies, but markets, Druckenmiller is your man. Okay, page 2. Yield management has always begins as a technical operation, ends as a policy commitment. Basically, we did this during World War II. We kept it after the war, and it financed deficits because we kept borrowing money really cheap. In 1951, we finally got rid of that, and we had to quietly tax a generation of savers to put our house back in order. So once the markets believe that the Treasury is defending a price, every rise in yields becomes a test of official resolve, and operations must grow to survive tests. So let's say the market thinks the Treasury is defending 5.3 in the 30-year bond. They're going to try to test it, push it. Will the Treasury be there? Will they be there? If not, they'll test 550, and you'll have to keep testing. You have to keep defending. There is a quieter cost, and I mentioned this before. You buy long bonds and fund purchases with bills that shift duration. You basically put your risk to the front instead of in the back, and you have to refinance more often. So front rates have to go up. You're actually not locked in for 30 years. You're only locked in for 6 months, a year, or 2 years, and that's important. The fact that this is happening during the final stretch of a very important midterm congressional campaign, it hurts the credibility of the Treasury market. And this is credibility that's been bought over many decades, if not centuries. And this hurts it. And he says, and this is just a very good point. He says, when he toured college campuses 10 years ago, he said, entitlement is basically generational theft. You borrow to give a lot to the current generation, which is, sort of controlling the levers of power, but you're actually taking it away from the next generation, which have to borrow even more at more expensive prices. He said, transfers accounted for a quarter. Transfers, that's transfer payments. That's Social Security, Medicare, Medicaid, and other, sort of government programs that give away money, was 25% in 1960. They're 70% today. That's why we really can't cut our budget, because you only have 30% left to cut. And that of that 30%, a pretty good chunk of that is military, and we really can't afford to do that. He says, if we continue where we are, interest expense reaches 4.5% of GDP by 2033 and 144% of all discretionary spending by 2043. So basically, you'll have to raise taxes or cut spending. Either we restructure the promises deliberately on our own terms, that means cutting the deficit, protecting those who most need them, or the bond market restructures them for us all at once on its own terms. That's what happened to Britain when they tried to borrow money that they didn't have, and they were no longer the world's reserve currency. So this sets a really bad example. So the problem here is you can't buy, what he's saying is you can't buy your way out of a solvency conversation with liquidity tools. You can only postpone the conversation and raise the eventual price. If the 30-year yield must trade at 5.5% to clear, that means to get enough people to buy it, it's not a crisis. It's basically the bill that has to be paid. It's an invoice. The only thing that durably lowers long-term yields is addressing the primary deficit. And he says you have to fix reform entitlements gradually and honestly, and a credible fiscal package would do more for the long end of the curve than the buyback program 1,000 times this size. He's absolutely right. And but the truth about democracies is you rob Peter to pay Paul, you're pretty much going to get the support of Paul. That's why nobody will touch entitlements. They call it the third rail of American politics for a reason. Finally, he says, governments defending prices against fundamentals always lose. The only variable is how much they spend before conceding. He would know this is the British the UK trying to defend the British pound in 1991-92. This is everybody who had a peg like Southeast Asia in the Asian crisis couldn't defend it. That's 1,000% right. We can do it longer than most because we're the world reserve currency. But there's a great lesson in here. So, basically saying this is a bad experiment. It will probably fail. Whether Bessent will listen is a different story. He may agree, but he has also to do something for President Trump. But this is an economics and markets lesson. Okay. Wall Street Journal also reports that NVIDIA has become a banker to the AI boom, putting it on dangerous ground. So basically, this is not really news, but they're saying the company is increasingly tapping its financial strength to keep customers buying their chips, which is what they want to maintain. A lot of money in the different deals, but here's an interesting one. NVIDIA also recently signed deals with 2 young cloud computing companies in Australia where it acts as a customer of last resort if they can't find others to rent their computing power to. In exchange, NVIDIA gets a share of the company's revenue from those assets above an agreed upon level. So basically, they take sort of a streaming share. It's like a streaming company where I invest in you, but I get some of your profits. And they describe these deals as a new business model, suggesting it could act as a financial guarantor many times over, saying we're basically divesting. It's spreading its bets so it's less reliant on a handful of tech giants like Amazon and Microsoft, which are running out of financial steam to keep buying. The overarching problem, though, for NVIDIA is its deals concentrate the risk it is taking in AI. So if there's a downturn scenario, not only would you see a reduction in revenue and profit, it could start stressing your balance sheet. So many things could go wrong at the same time. Now, NVIDIA reports tomorrow after the close and what will be the biggest near-term driver for the markets, I think. So what are we going to be looking for? And this is me. You're going to look for by how much does EPS and revenue beat expectations? Probably even more importantly is how strong are projections for the coming quarters? Is it really the extraordinary demand? Do they really beat it very heavily? Is it organic AI demand? How strong is the chip for the demand for the new chip? What we don't want to see is Jensen spending a lot of time defending vendor support, all these, all these circular funding things the market doesn't like, and this demand circularity. So right now, the market is pricing a 280 billion market capitalization move after earnings, or 5.5% of the price, $5 trillion at $210. So Nvidia trading about 212 actually. So it's about a $12 move either way. Not that huge. Has been larger previously. Remember, Nvidia reports after the New York close tomorrow, but that's before Korea opens on Thursday. So if you want to tweak your position, you're going to have to tweak it this coming day. So let's look at the chart. It's basically, sorry, this is Nvidia, not Dollar Canada. I didn't update that. Unpredictable. The market is in a questioning, doubtful mood. I think unless they really have an amazing press conference, an amazing demand, I think the chances are it goes lower. But not by a lot. I think, it would drop lower, maybe towards 200. And then I think it consolidates and probably bounces if overall the report is good. Okay, Bloomberg reports Xi signals defiance as U.S. threatens sanctions for Iran support. Hours after the U.S. sanctioned dozens of Chinese entities and threatened to target an unspecified major financial institutions for its dealings with Tehran, Beijing responded by saying its relationship with Iran should not be disrupted or undermined and will take all necessary measures to safeguard its interests. So, potentially another clash between the superpowers. Certainly China does not have any chance, does not have any interest helping the president. When your enemy, and we are their enemy, is having trouble, you just keep pushing them along. They don't want the conflict to explode, but they don't want to help Trump without getting something in return, because while the U.S. is focused in the Middle East, it's not focused in Asia. What I think you'll see is Beijing could say, you know what, we will reduce oil purchases, we'll hold their money until they come to a deal, but they probably get a lighter hand. It remains to be seen what economic D-Day is going to be. Bloomberg reports that OpenAI claims its new chips can outperform NVIDIA processors. OpenAI said its new jalapeno chips perform better than NVIDIA's current lineup during testing. Now it beat it in two categories: the amount of AI work it could handle per unit of power and its speed at returning responses. They're going to start making these new chips, using these new chips to support AI models later this year. It significantly reduced costs. It's a good chip. They're designing it as long as they can increase production and the cost savings are material as expected. Their partner in this is Broadcom. Some chips are more powerful at running AI tasks and other at fast responses, but Jalapeno does both. And the chip is also low wattage, 700 watts, which means OpenAI will save money when running its data centers where power is a key cost. Now, just to be sure, Jalapeno wasn't tested against the newest generation of NVIDIA chips, the Rubin chips, and it's not really good at training models. It's really good at inference. So this is a result that should be good for Broadcom. But we look at the Broadcom stock, not really trading that well. Earnings are in about a week and a half, September 2nd, after the close. The chart just doesn't look great. No, it has very little energy. Okay, quick look at crypto. We can see here, this is CoinGlass again. Volume in Solana up sharply, 40% over the last 24 hours, down a fair bit in Ethereum. And then we look at liquidation, not a lot of liquidation. I think a little more liquidation in Bitcoin, but the star of the day is definitely Solana, trading near 100. Okay, the markets. Bonds are up again, and this is because crude is down and there's a little less fear of inflation. So bonds are up, crude is down, equities small up, the dollar's flat, metals are unchanged to lower, gold won't back off, and crypto is unchanged a little bit to a little bit higher. The NASDAQ up 0.5% with no direction. The S&P 500, tech is doing okay, but consumer, defensive, and energy are dragging. You can see some green here, but otherwise, not a lot of energy. Finally, quick look at the data here. ADP employment change. 4-week average is now almost 12,000, up from 9,500 last week. So ADP ticking higher for the third straight week. I think we have seen the weakest employment report for a bit. So I think the last month is probably going to be the weakest. I think we'll be better this month. Home sales are not good, but permits are up, and confidence low, but actually not that much lower than before. Tomorrow we get core PCE and NVIDIA. Quick look at the Fed Watch. really hasn't changed very much. I mean, there's still only a 60% chance that the Fed doesn't hike in September. That is that is just not enough. I mean, I don't think the Fed, I think, has a less than 20% chance of hiking. Thanks for joining me today. I will see you again tomorrow. Thanks for watching.